Welcome to Expert Investor Link, our virtual platform to bring you valuable insights from fund managers. During these turbulent times, it is important not to forget that we are investing on behalf of our clients for the long term. I am delighted to be joined by Kirsty McLaren, who is the Emerging Market Equities Investment Director at Schroders. Today, she will be talking to us about the role of emerging market equities in our clients' portfolios. Welcome, Kirsty.
Thank you, Rohit. And today I am going to focus on the long term because what I'm going to do in this presentation is I'm going to re-examine the case for a strategic emerging market equities allocation in a global portfolio. So investors are increasingly using more sophisticated methods of portfolio construction. And in this context, I'm going to discuss how an alternative rationale for emerging market equity exposure can fit. So in the following slides, I'll show how emerging market equities can form a key component of portfolios constructed using these more sophisticated techniques. First, though, we begin with a traditional case for emerging market equities. Now, investors have traditionally allocated to emerging market equities for three principal reasons: to enhance return, to access higher economic growth, and/or to diversify developed market equity exposure. Let's look at each of these reasons in turn and assess whether we can achieve any of these objectives through a simple allocation to an emerging market equity index. The most common rationale for emerging market equity exposures in asset allocation strategies is to enhance expected returns. Unfortunately, though, as the chart shows, a large degree of patience has been necessary. There have been multi-year periods when emerging market equities have underperformed developed markets. There is some good news, though, for advocates of emerging market equities. Actively managed emerging market funds have, in large numbers, substantially exceeded a passive alternative. So this chart shows how a passive investment approach, owning the iShares MSCI Emerging Markets ETF, has performed over one-year rolling periods by placing it in a universe of actively managed emerging market funds and measuring its percentile rank. So lower numbers on the y-axis are good and higher numbers are bad. As you can see, the passive index ETF tends to spend the majority of the time in the bottom half of the universe, meaning that many, if not most, active emerging market funds, net of institutional fees, do better than the passive alternative each year. Now, active funds' outperformance is at least in part explained by some of the features of emerging market indices. The opportunity set for an emerging market equity investor has changed dramatically over the last 30 years, as developing countries have opened their markets to foreign investors. Such changes introduce opportunities for active managers who can invest outside their benchmark, as well as raising the costs of a purely passive approach, which is forced to trade as the benchmark index changes. And this feature, which is not apparent in developed markets, lends weight to the argument for an active approach in emerging markets. Now, beyond the simple rationale of higher expected returns, a common argument for emerging market equity exposure is the scope to participate in significantly higher economic growth compared with the developed countries. However, as this chart shows, higher economic growth in emerging countries does not appear to be associated with higher equity market returns. Now, there's a number of reasons why economic growth in emerging countries does not necessarily translate into equity market performance. The listed sector in an emerging country is not necessarily a good reflection of the economic structure of that country. Furthermore, in many emerging countries, there's a significant number of state-owned enterprises whose priorities are not always aligned with those of minority shareholders, and who may have other mandates, such as providing employment or maintaining exposure to strategic industries. Now, lastly, the description emerging actually relates to the equity market, not the underlying economy. So a country like South Korea, with per capita GDP similar to Spain or Italy, is an emerging market, as is Qatar, whose per capita GDP is higher than the US. And we'll return to this definition point later. So the third and final major traditional rationale for including strategic allocations to emerging market equities is diversification. However, emerging market equity exposure gained through the standard index benchmarks is dominated by the impact of the US dollar. The chart shows how the MSCI Emerging Market Index, the dark blue line, can be mimicked by the mid-blue line, which is a combination of the MSCI World Index and a US dollar exposure. This substantially weakens the diversification argument for emerging market equities. So we've reviewed the traditional rationale for a strategic allocation to emerging market equities and a global portfolio, and found that evidence provides only weak support. But that's not the end of our story. As I noted in the introduction, investors are increasingly looking beyond traditional asset allocation processes towards more sophisticated methods of portfolio construction. Two particular approaches, adopted either for entire portfolios or for specific buckets, are diversified risk premia. Now, this approach involves identifying separate sources of risk premia and then constructing portfolios to access them. Thematic approaches. This involves identifying global themes that are expected to drive excess returns and then again constructing portfolios to capture them. Next, I'll explain how emerging market exposures can form a key component of portfolios constructed using these techniques. Let's start by considering the role for emerging market equities in risk premia approaches to portfolio construction. The natural question to ask is whether emerging markets themselves represent a separate risk premium. However, the fact that, as we saw earlier, a very significant proportion of the returns of the emerging markets index can be attributed to developed market equities, plus the US dollar effect, suggests that in reality, emerging markets, as represented by the benchmark index, cannot be viewed as an independent risk premium. However, further analysis suggests that an emerging market premium could be embedded inside the broad index if we focus specifically on the development of capital markets. So these charts show strong positive relationships in emerging markets between changes in regulatory quality and equity returns on the left-hand side and changes in political stability and equity returns on the right-hand side. So it's the development of institutions that support the capital markets rather than the development of the underlying economy that can earn the unique risk premium. We're back to the definition point of what makes an emerging market. Now, it should be noted that this premium cannot be accessed by index exposure, given all we've said about the replicability of the main index. Instead, a solution targeting the specific risk premium would need to be constructed from exposures focused on capital markets that earn a low score on these factors. Next, we turn to global themes. Given their geographic spread across the globe and the specific relevance of themes such as disruption and demographics, it should not be surprising that emerging markets can play an important role in theme-based strategies. Whilst few of these themes are captured entirely through emerging market exposures, these exposures can complete solutions that are not well represented in developed markets. And I've listed some major themes on the slide. None of these themes are likely to be captured by simple index exposure, and instead active portfolios are required to achieve meaningful impact. To conclude, the traditional rationale for emerging market equities exposure is not overwhelmingly convincing. However, there is some evidence that emerging market equities may offer a unique risk premium linked to the markets themselves. There are also important themes that are rewarded in specific emerging market exposures. So there is a strategic case for emerging market equities, but you can't just buy an emerging markets index and expect that to work. You need to take an active approach.
Thank you very much for sharing that with us, Kirsty. That was really insightful, and it's always good to remember the long-term opportunity in emerging markets. It's quite easy sometimes to get swayed by the short-term volatility and what we hear in the markets. So sometimes it's very good to remember the long-term view. So thank you very much for that. I did have a question for you. We cannot talk about any stock market in this current environment, at the end of April, and not talk about what's going on globally. Thinking about the themes you discussed in your presentation, what, if anything, has changed as a result of the pandemic within those themes?
That's a good question. I think that the pandemic, in a way, reinforces some themes and potentially accelerates others. So, for example, if we talk about the shift online and digitization, so e-commerce and online gaming, etc., are all well known. but we're seeing increasingly a shift towards working from home. Companies have had to conduct a huge experiment to see how that works. And I think that when this pandemic is over and we go back towards normal, then there will be a lot more remote working taking place. So that will help to accelerate that shift to digitization. I think that companies will be looking again at their supply chains. So this feeds into the globalization theme. I think the era of having very long supply chains that were very lean is over. That companies will look to build some flexibility into their supply chains to make them more robust and to nearshore supply where possible. I also think that companies will be looking at automation more closely as well in terms of production. And then finally, we list there the US-China axis, and clearly there are several ways in which the pandemic will affect and will add sort of further to that relationship and potentially to China's desire to continue the move away from a unipolar US-dominated world.
Let's talk about the whole emerging markets universe. That, it's a pretty big universe, and we have historically always looked at it as emerging markets. But if you then look at specifically within emerging markets, are there any particular regions, geographies, sectors that you're currently finding more opportunities than others? And has that changed in the last 12 months?
So I think in general, emerging markets are less well placed to handle the pandemic than developed markets. They generally have more open economies that are more exposed to global trade, and many of them have large commodities exposures as well. In addition to that, you on average have healthcare systems that are less able to handle the pandemic, and you potentially have institutions as well and governments that also may not be able to manage the pandemic as well as those in developed markets. Now, however, as you yourself said, there's a large spread within emerging markets, and when it comes to ability to handle the pandemic, there's a large spread as well. And that's one thing that we have been looking at within our country allocation process at the moment, is the dispersion in how emerging countries can handle the virus. And that has certainly gone into our thinking on positioning. But essentially, we remain cautious looking ahead as to the outlook for emerging markets and for asset prices in general, because there is still a huge amount of uncertainty in the world as to how this virus is going to play out. And as a result, we're kind of reluctant to take a beta view on emerging markets right now. And instead, we're focusing on stress testing our portfolio, looking at individual holdings, putting in some fairly aggressive assumptions of revenues and time taken to manage through the coronavirus pandemic, and making sure that we're confident that the companies that we own can come through this and can exit the pandemic successfully.
Thank you very much for that, Kirsty. It's been a delight to speak to you and hear from you. And thanks to you for listening to this conversation. I hope you have found it useful. If you do have any questions for Kirsty, you can submit those questions just below this video.